Good day, Dan Kurz, DK Analytics. It's December 17th. I paused because of yesterday's Federal Reserve Board meeting, the FOMC meeting. The Fed finally went ahead and did it after a drought of 7-8 years of zero, or effectively 0% interest rates, what banks charge each other, and the basis of all other interest rates that depend upon the federal funds rate. They went ahead and did it. They raised it from something like 0.1%, or effective 0, to 0.25, with more increases promised in the pipeline as they try to move towards some semblance of normalcy as to the cost of short-term funding. Well, I've got some news for everybody, and it's probably not news, but you know it. The Federal Reserve can increase interest rates. Even if they move to 1%, it's still a fraction of normalcy, which is between 3 and 4%. And we have, in essence, an economic policy that has been built around cheap money, misallocations, the reduction in the strength of the rule of law and in property rights. We have no regulatory sanity, over 6,000 new edicts put out by the federal government, about 30,000 in the last 4 or 5 years. We have global issues in terms of property right usurpations, whether it's through currency debasement, whether it's through the massive amnesty that OECD countries are in effect bankrolling and providing those people that come on board welfare benefits, social safety net benefits that they have actually no payroll deposits to speak of, or no contributions that they've made. So we're seeing at whether it is regulatory insanity, whether it's money printing, whether it's codified massive amnesty into developed nations, we're having a transfer of property rights away from Main Street, away from the sovereigns towards people that are cronies and people with intentions in government that are not representative, that are not in keeping with the tradition of a republic and the constitution of states that were built on behalf of people and maintenance of their rights. So the Fed, circling back, can print even more money going forward, and we'll get to that in a second, and we think it will. But it can go and raise interest rates nominally from effectively 0% even to 1%. But we're not really addressing the issues which have led to this tremendously weak economic growth, these huge misallocations, the huge real unemployment rate, the very low labor participation rate in the United States, and the sagging productivity around the world. So we can go and, in essence, have a poisonous public policy cocktail mix around the world that moves us further away from the rule of law, from property right protections and thus liberty. In other words, from sanity, from what worked, in a way back to, if you will, the playbook of the old USSR or a fascist playbook under the current leader of Russia, namely Putin, where we don't have codified and protected property rights, where people place themselves above the law. And allocations are made, not because they make sense along the lines of the invisible hand of Adam Smith, and protect people's earnings from extortion by people that, in essence, are despots of one flavor or another. Now, in case you think this is too far off the beaten path, I will ask you why then it is that after coordinated 5-6 years of massive money printing by global central banks, by zero or even negative interest rates, why the global economy can't get out of its own way and is now, by the way, succumbing to, you guessed it, the business cycle. We've had a tremendously artificial recovery with these huge balance sheet expansions, these huge Keynesian disaster experiments with 0% interest rates, which in essence have left savers high and dry. Pension funds are scrambling. Insurance companies are scrambling People that offer annuities are scrambling. And at the same time, we are enabling sustained increases in debt. We're underwriting the government. We're underwriting student loans. We're underwriting car loans. We have, in essence, huge junk bond balloons that have been blown up on the back of this monetary insanity, financial repression, in essence, pushing aside common sense and property rights and the rule of law. And as a result, we have a global economy that is very dependent on, if we don't move back to sound policies, it's very dependent upon sustaining the unsustainable. In other words, 0% interest rates, money printing, because if we don't get back to a free market capital, liberty-centric, property rights-centric economic system where the free market does its thing, and we let assets correct in price and businesses go out of business that should, instead of promoting those that should have gone belly up and burdening those that are sound to in essence pay for those that can't run the show correctly. Well, as far as the Fed is concerned, as said before, they are not going to take out the business cycle. They haven't rendered that academic. We're very near to business cycle-based recession. We're about 1 to 1.5 years longer in this highly artificial, manipulated, fiscally and monetarily business upswing, which if you looked at inflation numbers the way Wall Street doesn't see them, the way Main Street does, we probably wouldn't have had or recorded any real GDP growth in the first place. So call that what you will. Fact is, we have increasingly perverted allocations, not by the free hand of Adam Smith, but by financial repression, by regulatory insanity. We see the whole green debacle, the entire hoax of CO2 being pollution instead of plant food, and thus oxygen, a vital indirect source of oxygen. We see the efforts in Paris. We see other efforts that threaten to extort, to shake down property, hard-won property, earnings that get tabulated in equity and elsewhere by those that would have us be, in essence, subjects instead of sovereigns. So as this cycle continues around the world, and we see from the Baltic Dry Index to U.S. tractor-trailer shipments to the indices, both manufacturing and service-based, that are heading down to production, the economy in the United States, the manufacturing sector being down 1.2% year over year in the month of November, the biggest decrease outside of a recessionary period in something like 40 years. So all these things come together, and we obviously have China, the great unwind, where it can't continue to invest 50-60% of GDP in artificially based, central planning based investments or capital structures, or developing ghost cities or airports that are unnecessary. And unfortunately, it isn't just China doing this. As said, thanks to financial repression, we're getting much of the same throughout the world. It isn't lost to people that pay attention that not only do we have issues with rising debt mountains, I mean, the globe has added since 08, 09, something like $60 trillion in debt. The rate of growth in a global debt is something like 10 times as high as the global GDP growth rate. And we also, despite all this debt-laced, debt-based, unsustainable growth, the misallocations have yielded us, you guessed it, declining productivity growth and actually negative productivity that's increasing, which if we now double down on a central bank policy that allows these kind of insanities to go forward, that's one thing. That's like saying you've got an unhealthy patient, he's eating incorrectly, he's living incorrectly, isn't exercising, but you're going to pump him full of some drugs that allow him to function and maybe even lay steroid into his diet, whatever that health cost is longer term. Well, our global economy isn't healthy, so unless we revert back to sound regulatory and tax policies, unless we move away from a government like the U.S., which adds something like 6,000 new regulations at the administrative level, unconstitutionally so. These are in essence laws that only the Congress that represents people should make. But unless we move away from regulatory insanity, taxes which are anything but sane, and obviously financial repression, i.e. Zero or negative interest rates and massive money printing that allow governments to live way beyond their means and double down on policies which in essence eviscerate property rights of the free market participant, which is why we have such a weak economy around the globe. So my point is this, as a takeaway, food for thought, the Fed will have to undo its attempts to late in the day, and the Fed has been a great contrarian indicator forever and a day, by the way, but the Fed's efforts to push short-term interest rates towards a normalization will fall far short. Normalization on the Fed funds rate is 300 basis points, 400 basis points, or 3 or 4%. We're not even going to get to 1%, I don't think. Why? Because we are in a global situation where the misallocations and the decline in productivity that has resulted are so severe, layered onto the combined productivity and also demographic or age-based issues, that we will have to revert. That is, the Fed will be rejoining the Bank of Japan and the ECB and the People's Bank of China before all too long, because we have not given the necessary oxygen to the U.S. economy to resume a normal, healthy, self-financed growth trajectory. As such, I would be remiss if I didn't close out this video by telling you that if the Fed does 1, 2, 3, 25 basis points increase in the federal funds rate without tanking markets, without causing junk bonds, which are already under a lot of pressure, to totally go into a market where there are no bids for these and yields go sky high. If we can avoid that, or perhaps if those things do happen, the Fed will have to reverse course in relatively short order, because we have no choice unless we revisit sound economics, the rule of law, property right protections, sound regulatory and tax policies. We will not resuscitate a healthy, growing economy, the invisible hand of Adam Smith, the right to ship. So, if we sustain this toxic public policy cocktail, which I will bet you $1 to donut that we will, we have no choice, that is in the United States, but to bring back Fed largesse. First by capping what will be, I think, and you heard it here first maybe, a very truncated increase in the federal funds rate, staying far below what is normal. And secondly, I think the Fed will have to revisit in a manner larger than ever, I think, QE, money printing. Because people, the bond vigilantes, will be coming back. They will see that the U.S. debt is totally unsustainable. We're at $18.5 trillion in debt. Tax collections are perhaps $3 trillion a year. So we've got a leverage of 5 to 6 to 1. Everybody talks about debt to GDP, but you pay taxes with income. So we're at over 6 times. And that's without taking into account all the off-balance sheet Social Security and healthcare liabilities that are increasing to the tune of $4 or $5 trillion a year. So the Fed will have to double down on the only instruments it has, because we're not going to have a government, be it at the judicial, the executive, or at the legislative level, that is going to revisit constitutionalism and sound economic policies, and not only in the United States, but around the world. So where does this lead us? I think this is an excellent opportunity, if you haven't yet, to purchase physical precious metals, because as it becomes clear that the Fed can't sustain a course that suggests hard money is making a comeback in the midst of a toxic public policy cocktail, which obviously it can't, as said. The Fed will be rejoining, and I think on steroids, if you'll pardon me using that expression one more time, what the Japanese and the Europeans and the Bank of England and the People's Bank of China are already doing. In other words, throw caution to the wind. It didn't work. That patient can't be resuscitated because we're not doing what we need to heal him in a sensible manner by stepping back and letting the free market reassert itself. So gold, silver, which, by the way, people always say if interest rates are going up, gold and silver are bad investments. That's just not true. If you look at the Fed funds rate, which was raised from 1% to 5.5% under Greenspan, gold didn't even care. It went up like crazy. On the other side, when interest rates went down or stayed flat, gold at some point came under pressure and has now corrected substantially. I think all of you, when I say gold, I mean gold and silver. But all of you are aware, I think, if you're at all in tune to what's happening, that the gold and silver prices are massively manipulated through one or another form of naked short selling in futures or in options markets. This is helped along by the bullion banks, which are holding hands with central banks that don't want real money over time, gold and silver, to rise amidst what they're doing, amidst financial repression and absolutely toxic public policy that has been instituted and expanded on around the world. So once that gives way, gold and silver are flowing in massive numbers to the east, to China, to India, to Russia, and the shelves are practically bare in the West. We've seen this before, and at some point the price of gold will no longer be made in the paper gold markets, where there's up to 300 times before they redo the books, let's say just multiple times the amount of gold available in paper format compared to what is actually deliverable. Those deliveries have been satisfied by accepting paper money, but that might not always be the case. This whole dam is going to break and physical gold will reassert itself. This will probably be given a big lift as soon as it becomes apparent to more market participants that the Fed has to reinstitute very aggressive monetary policy because we're not going to revisit sound economic policy. So it's a big opportunity. I think the same holds true, by the way, for oil-based assets. We put together a piece on a website, a post number 12. Will big oil, in essence, be big tobacco revisited? Encourage you to take a look if you get a chance. I think oil, which we're going to need no matter what for reasons I go into in that report and elsewhere, has been pushed down to a degree that will likely look at like a bargain for anyone over a 6-month or a year perspective. Why? Because we need oil almost as much as we need water and oxygen, and the incentive for people to drill isn't there. Most majors couldn't make money when they drilled at $100, and they're certainly not going to make it at $30 or $40. So a lot of projects are shutting down. This has a long, very large shadow that it casts on the ability to extract oil, which is ever more difficult to get out of the ground because it's more difficult to reach. It's offshore, and oil increases demand-wise about 1% a year. We've got the emerging world that can, in essence, only sustain some kind of productivity growth by deploying more machines, which obviously consume energy. So physical gold, physical silver, held outside the banking system if you can. Liquid oil assets, we point to ETFs that we suggest for you to good diversified approach or catch, if you will, of the secular oil and also the oil service group or people, companies. And also we suggest the same thing might be of interest in the agricultural infrastructure arena, which we also go through in our site. Last but not least, I would be taking the opportunity to lighten up on long duration bonds and stocks. We've suggested shorting NASDAQ. We have information on our site about that, and also junk bond yields, junk bonds themselves. We think the spread relative to treasuries has no way to go but up. We think treasuries will also at some point be heading up as people realize, that is, the yields will head up, the price of the value of treasuries will head down, because in essence, the government in any Western state is totally bankrupt. And at the moment, the United States has the advantage of selling the world that it has the only vibrant, strong economy, which, as we hopefully indicated, is an utter total joke. It's a statistical illusion or worse. And as that comes to the forefront and the Fed's forced to reverse, we're going to see people revisit scarcity assets. And I think that's where investors that have a strategic orientation should go as they lighten up on overvalued bonds and stocks, which are going to get clocked, stocks for huge earnings issues. In other words, earnings are going to come down. If history is any guide, good 40 to 50%, perhaps more from current levels. They're very artificial earnings. They're stock buyback-driven earnings. There has been no organic growth. It's slower than the GDP rate. The S&P 500 companies have had no organic growth. So it's been through stock buybacks, substituting equity with debt, and juicing the EPS way above the top line or even the bottom line. Those are all very suspect, and stocks are overvalued. Bonds are very overvalued, including 10-year treasuries, or globally speaking, bonds that are in some cases like Switzerland, offer nominally negative yields. And take the funds from selling overvalued stocks and bonds, put them into these scarcity assets, and ratchet up the cash in your portfolio, and do so in a fashion that mitigates bail-in risks and other risks that banks provide with today, and governments are in cahoots with them. Take a look, if you would, at our site for details. I hope this helps you navigate what is surely going to be a very interesting and possibly unsettling period ahead. Set aside cash, get into real scarcity assets, lighten up on overvalued stocks and bonds, and hold on for what will likely be very interesting times and better buying opportunities, especially as concerns investment grade or blue chip stocks that are going to have much more interesting, appealing dividend yields when the stock market is at 50% of the current level. Those are the ones that we'll want to switch to. The passport there is silver and gold. If you're staying in stocks, play the scarcity, but overall lighten up, get more liquid, and brace yourself. Get out at a good level, at a level in stocks and bonds that is totally disconnected from economic reality, inflation risks, and solvency risks. The latter two concern bonds, obviously. And do it while the getting is good, because when this whole thing comes apart at the seams, you likely will not have the time to reposition your portfolio at the attractive prices that allow you to do that today, as we continue to not have markets, but manipulation. So use this manipulation as a gift. Use the central bankers, the central policymakers, the global financial repression, and the wheels are going to come off the bus, but use the pricing today of perfection in stocks and bonds to start to rejigger your portfolio for turbulence ahead and to also maximize the opportunity to buy assets when Mr. Market and bond vigilantes return to determining more of how assets are valued. I thank you very much for tuning in. I hope you found this of interest, and we look forward to seeing you on our site, www.dkanalytics.com. This is Dan Kurz. I wish you a Merry Christmas and a Happy New Year, and all the best as we sail headstrong into a new year. Bye-bye.